Hello, my name is Robert Armstrong, and I'm an attorney, and I've been practicing law in California for the past 11 years. And I practice in the area of trusts and estate planning. Now, that means I don't do any other kind of work. I don't do any personal injury work, and I don't do any bankruptcy work. And if you're having problems with your spouse, I can't help you because I don't do any divorce work. And you know, I live in fear that some friend of mine is going to call me from jail one night and want me to get him out of jail. I don't have a clue on how to do that because I don't do any criminal law work. But you know, I do a lot of estate planning, and I hope that's why you have this tape, is to find out about estate planning, but not just the general topic of estate planning. You're more interested in finding out about how a living trust can help you in planning your estate. And that's the only area that I practice in, is creating something called a living trust. But whenever we talk about estate planning, you know, we have to say what estate planning is and define our terms. Let's talk about estate planning. Estate planning is really broken into three particular areas. There is the area called accumulating your assets. You know, that's gathering together all of your wealth, making sure that you've got an estate to begin with. Now, some of you have large estates, and I know that some of you have small estates. But whatever the estate is, it's yours, and you want to protect it. The second area of estate planning is something called preserving your wealth or your assets. And that means protecting it from income tax and government interference of all kinds. But the last area of estate planning is what we're here to talk about, and that is the distributing of your assets when you die, making sure that all of your wealth goes to the people and the places that you want them to go to. Not where a bunch of attorneys say they should go, not where the government tells you it should go, but where do you want it to go? And you know, there are some powerful obstacles out there preventing you from passing the property to the people and places that you want them to go to, and that's what we're here to talk about. We're going to talk about the three evils of estate planning. And the three evils of estate planning, number one is something called probate. Now, you've all heard about probate, but there's a whole lot of misconceptions about it, and we're going to make you experts on probate by the time this tape is done. Probate is not the only evil, however. We also have to talk about death taxes. Now, that's what happens when you die and the government gets its big hand into your estate and takes a lot of your wealth out to pay for its government programs. And you know, everyone's heard of income taxes and property taxes and excise taxes, but there's a tax that happens when you die, and it's known as a death tax, and we're going to discuss that. And the final evil is an evil I think that many of you are unaware of, and it's becoming something that you should protect yourself from. It's something called a conservatorship, and it happens before you die. That's what happens if you become disabled. You know, unable to manage your property because of a disease or an illness or an incapacitating injury. And this is a program called conservatorship. And the conservatorship is a legal proceeding in the court where the attorneys are appointed to manage your estate. And it's very expensive, time-consuming, and many people think humiliating. Those are the three evils of estate planning. Now, how do I tell you about these? Well, you know, whenever I hear lawyers talk, when I go to conferences and seminars, it seems that all they want to talk about are the probate code and the Internal Revenue Code and the Revenue and Taxation Code and all of those technical journals and all of those technical periodicals. Well, I don't want to do that because it's boring to me, and I know it's boring to you. What I would rather do is give you a conceptual understanding of what estate planning is all about. And the way I want to explain it to you is to talk about a couple of people, a couple of real people, a man by the name of Bill and his wife Mary. Now, Bill and Mary have been married for a long time, and they live right in your state. They have a couple of children, a boy by the name of John and a daughter by the name of Susan, and they've accumulated an estate just like you. Their estate totals $600,000. Now, I know some of you are saying, who do you think you're talking to? My estate isn't $600,000, and it never will be. Some of the rest of you are saying, well, who does he think he's talking to? My estate will never be that low. Well, I don't know what your net worth is. I use $600,000 because it looks after all of the issues in estate planning. If you're a single person, you know, unmarried, widowed, or divorced, the trust and this estate planning concept is just as good for you as well. We're not going to be talking about the 3 periods of estate planning for a single person. We'll just be talking about it while you're alive and after your death. But let's talk about Bill and Mary for a moment. They've got these couple of kids, the daughter Susan and the son John. They've got a $600,000 estate, and they live in a state just like yours. And what they want to do is they want to pass their estate on when they die. When the first spouse dies, they want it to go to the surviving spouse. And when the surviving spouse dies, they want it to be distributed to the kids in equal shares. Well, you know, Bill and Mary are like about 70% of the American population. The Bar Association tells us that 70% of you don't have any estate plan at all. You don't have a will, you don't have a trust, you don't even have a scrap of paper anywhere in the world that would tell your family or your friends where you wanted your estate to be distributed if you were to die tomorrow. Does it sound familiar to some of you? Well, Bill and Mary were no different. But Bill had a heart attack last year. It wasn't a serious heart attack, but it was enough to make the family realize that they better do some planning. And so you know what they did? They did what every family does that does estate planning. They called up a lawyer, and they asked the lawyer to write them what? Well, you said it, I'm sure, to yourself. Asked them to write a will. Because we've been telling you for years that you should have a will when you die. You know, it should be current when you die. It should be updated when you have kids. And it should be updated if you get married. But in my estimation, ladies and gentlemen, a will is the most dangerous document that you can use to plan your estate. I hope you're shocked. It's dangerous not just because I say so. It's dangerous because it's an engraved invitation into the probate court. It's an engraved invitation into the clutches of my profession, the legal profession, and we have to be honest here today. We've been getting fat and rich for years off of your deaths because when any one of you dies, the estate has to go through probate. And we handle the estate in probate, the legal profession, and we charge a lot of money. And I think you'll be surprised just how large the fees are going to be. But Bill and Mary didn't know anything about that. They just thought they needed a will, like most of you thought. And so they called up an attorney. He was a friend of the family. He had done some real estate work years ago for the family. And they said, could you write a will for us? And he said, well, sure, if it's not too complicated. You know, I'm not an estate planning lawyer. I took some classes, however, in law school that would help me do a simple will. So if your estate's really pretty simple, I'll write the will for you. And Bill said, yeah, well, couldn't we come on down and talk about how we want to distribute our estate? And he said, sure. And they went down to the office and they sat before the attorney. And Bill said, you know, if I die first, I want all of the estate to go to my lovely wife, Mary. And Mary said, but Bill, if I die first, I want the estate to go to you. Now, where do you think they wanted the property to go after both spouses were deceased? Well, you're right. They wanted it to go to the kids, half to John and half to Susan. Now, this is called an I love you will. It's the all-American estate plan. Husband dies first, it goes to the wife. Wife dies first, it goes to the husband. It's split up among the children after both of them are gone. And the attorney said, you know, I think I can handle that one. And so they went home, and about 2 weeks later, they got a draft copy of the documents in the mail. And Bill and Mary sat over the kitchen table, and they read this last will and testament, and they reviewed it, and it appeared to do exactly what they wanted. If Bill died first, it went to Mary. If Mary died first, it went to Bill, and the remainder was divided up among the kids. They called the lawyer back up, and they said, what do we do now? This will looks okay. He said, come on back down to the office, and we'll sign the final documents. And they went down there. And they went the second time to this attorney's office, and there they were met in the conference room. You know, an attorney's conference room, the walnut paneling and the mahogany desk, and it seemed like the entire law firm was assembled around the desk watching Bill and Mary sign their final documents. And they had signed the documents, and they were just about ready to leave when the attorney said, Bill and Mary, I see you're about to take the original documents home with you. Well, let me ask you a question. What if there were a fire or a theft? What if we had a big earthquake? What would happen then? Would you have a very safe place to store these original documents? And Bill turned to Mary and said, you know, Mary, we don't really have a very safe place to store these important documents. And the attorney said, well, don't worry about it at all. And he leaped for the table and he grabbed the original documents and he said, we'll store them for you and we'll store them free of charge and we'll put them right here in our fireproof files, right here in the law firm. And Mary turned to Bill and said, you know, they say so many rotten things about lawyers these days, but here they're offering to store our documents for us, absolutely free of charge. And Bill had to agree it was a pretty nice thing to do. Now, he's explaining to you his experience of getting his estate planning done. You know, he's been putting it off for years, and he's pretty proud of himself. And you thought, wait a minute. This had to cost Bill and Mary a fortune, because you know the average billing rate for an attorney in the United States of America is, what, about $100 to $200 an hour? And here they went down for a consultation. They had some draft documents prepared. Then they went back down to sign the final documents that were prepared on beautiful paper. And then the law firm was even going to store the documents for them free of charge in their fireproof file. Well, it must have cost Bill and Mary a lot of money, right? Well, Bill said, no, don't worry about me. She said the total cost to create all of those documents was the total sum of $40. And you thought, wait a minute, how could the law firm do all of that work for $40? After all, you knew that the legal profession was not a charitable institution. You knew that the monthly payment on the couch in the attorney's lobby was probably more than $40. And here, that's what Bill told you it cost to get both his will and Mary's will created. Well, you knew there must have been a catch someplace along the road. You knew that Bill and Mary were going to have to pay more money somewhere later. And you know you didn't have to wait very long, because about 6 months after Bill signed his final documents, he had his second heart attack. And this time he wasn't quite so fortunate. This time he died. And you know, the first thing that you found out was that all of the assets owned by Bill on the date of death, well, lo and behold, they had to go through a legal proceeding called probate. Probate. Many of you thought, I know, that if you got a will, you were going to avoid probate. Well, nothing could be further from the truth, and most people just don't understand probate. They think that probate's got something to do with taxes. Probate has nothing to do with taxes. Probate is simply a legal procedure that has a modest objective. All that they do in the probate court is they change the title of the assets. You know, your assets are owned by you. If I went down to the county recorder's office and looked at the deed to your house, it would have your name on it. Well, when you die, you want that property to go to your beneficiaries. Well, it doesn't happen automatically. The title needs to be changed into the name of the beneficiary. And the only legal institution that is entitled to change the title to assets is the court system. And it's probate court when you die. And your will is nothing more than a little letter to the judge, telling the judge how you wanted your assets distributed, and to the names of your beneficiaries. Now, you say, well, is that all they do in probate? Well, no, they look after some other things as well. You know, probate has some other objectives. What they do is they have a forum. That means they invite anybody in the community that's got an interest in Bill's estate down to the court. And you know, people go down there all the time. Disgruntled beneficiaries go down. People who claim that the will was procured by fraud or duress or undue influence, they go down to court and they complain. They contest the will. And we've all heard of this, haven't we? This is something called a will contest. In fact, what was the most famous will contest situation in recent memory? Well, I know a lot of you are saying Howard Hughes, and you're right. Howard died with what, an estate of about $2 billion, and when he first died, everybody thought, of course, that Howard Hughes didn't have a will. Well, we were real fools, weren't we? Because, you know, it wasn't more than a week into probate when wills started pouring in from all over the world. It seemed like everybody was a beneficiary of Howard Hughes' estate. As a matter of fact, the funniest one, as I recall, was that mechanic from Utah. You remember Melvin Dumar? They even made a movie about it. He claimed that Howard was wandering around in the desert one night, and he rescued poor Howard from his fate. And as his reward, Howard wrote him out on a will giving him his entire estate. And Melvin submitted that will to the probate court, and the judge had to decide whether that will was valid or whether it was invalid. And unfortunately for poor Melvin, the judge decided that that will was no good. You know the next thing they do after they decide whether the will's good and resolve disputes? They pay off the creditors. Anybody that's owed money by the decedent gets paid in the probate court. And after they do that, they appraise all the assets and they inventory them. And then they distribute the property with good legal title. And they change the title into the names of the beneficiaries. And in our case, Bill, who just died, his beneficiary was his wife, Mary. And so she gets the entire estate. She can do whatever she wants with it. She can buy, she can sell, she can trade, she can exchange, she can give it away if she wants, because it's good legal title and she's got it in her name. Now, why in the world would we say that probate is no good? Why are we calling it an evil? Why do we tell you you should avoid probate? After all, it looks pretty good to me. They resolve disputes, they pay off creditors, they inventory and appraise the assets, and they distribute it with good legal title. Well, the reason that we tell you that probate is no good, and many of you already know that, is because it has some severe disadvantages. Probate is very expensive, and the fees vary from state to state, but they all have one thing in common, that the person that gets paid in the probate court, it's not the judge, it's not the state, it's not the federal government, but it is the legal profession, the attorneys who take your estate through probate. And boy, do we get paid handsomely. Let me show you how the probate system works. The attorneys get paid in two ways in the United States, either by reasonable compensation, in other words, an hourly rate. Remember, we talked about the hourly fee of an attorney being either $100 an hour or $200 an hour, whatever it is in your particular locale. They get paid that way. And another way that they get paid in some states is by a percentage of the size of your estate. And the way it works is that generally the attorney gets paid based upon the gross size of your estate, not the net size. And let me show you how that works. Let's say that you were going to buy a piece of property, and let's say the property cost $100,000. Now, I know in a lot of places in the United States you can't buy a piece of real estate for $100,000, but just indulge me for a moment. Let's just say it cost $100,000. And let's say that you didn't have the full $100,000 to write a check to hand it to the seller. So what are you going to do? Well, you do like most of us do. You go to the bank or the savings and loan or the trust company, and you ask for a loan. And let's say that you really don't have much money, and so you have to get a big loan. Let's say that you get a loan for $99,000. Now, if any of you know how to do this, would you let me know? I'm sure that this is impossible. It's just an example. That means you got $100,000 the fair market value. You've just got a loan for $99,000, and if I were to ask you what your interest was in the property after the escrow closed, well, you would tell me that it was $1,000. That's your equity. That's all you put into the property. And if you died owning an interest in that property under the same scenario, and they were adding up your estate for probate purposes, and the attorneys were going to evaluate the size of your estate to determine how much money they were going to get, would they use the $100,000 gross fair market value amount, or would they use the equity amount of just $1,000? Now, most of you who are thinking about it would say it's only fair that they use the $1,000 level because that's all you own in the property. After all, you got to pay back the $99,000 to the bank or the savings and loan or the trust company where you borrowed it. But you know, the probate lawyers have a little bit different way of doing mathematics. The probate codes of most states say that the attorney is entitled to get the gross fair market value as his determining factor in figuring out his fees. And here's the kicker, ladies and gentlemen. They don't deduct for any liens or encumbrances. Now, the $99,000 level, that's a lien or an encumbrance, and they're going to ignore that. And they're going to take the full $100,000 fair market value. And that means that the probate fees in some states, for example, California, the probate fees would equal $6,300 on that $100,000 piece of property. And so if you only owned a $1,000 interest, that means it just cost you $5,000 to give away a $1,000 piece of property. It's not very fair, is it? Well, I hope you don't think so, because in addition to the attorney's fees that we've just talked about, there are other fees associated with probate. There's the fees that are paid to the executors, the fees paid to the appraisers, and the filing fees in the court system. There's even a bond premium, because if you name somebody who is outside the state that you die in, and they come into that state to manage your estate in the probate process, the court more than likely is going to require that they post a bond equal to the size of the estate, and that's very expensive. But you know, there's another problem too, and that's the length of time it takes to go through probate. Many people tell me that they're more concerned about the delays in probate than they are even about the cost. And we've all heard that probate takes a long time. The average length of time is generally in most states about 9 months to 2 years. But there are lots of celebrated cases that take a lot longer. You remember Marilyn Monroe? Her case took almost 20 years to wind its way through the probate court. John Wayne died many years ago, and his estate is still in the probate court. Although the average length of time is 9 months to 2 years, we know of many cases that have taken a lot longer. But there's also a problem that the probate process is a public record. That means anybody in the world that wants to know any of the details of your finances, or who your beneficiaries are, or who you owed money to on the date of your death, all they have to do is march down to the county court and look through the records, and it's all displayed. Your will is on file. All of the creditor claims, all of the beneficiaries' names, addresses, and telephone numbers are there for anybody to look at them. And most people are very concerned about the privacy of their estate. They don't want people to know the size of their estate and who their beneficiaries are. But if you have a will and you go through probate, it's all open to the public. But there's a psychological trauma also associated with probate. Going through this lengthy probate process is a constant reminder of the loss of a loved one to the family members, and it's very painful. And finally, the last evil that's associated with probate is that if you own real estate outside of the state where you die, there's going to be a probate in every single other state where you own real estate. So if you die in the state of California and had a piece of real estate in Wisconsin, Massachusetts, and Florida, there's going to be a probate in each and every one of those other states. So your heirs are going to have to go to those states and hire attorneys and go through the probate process. Those are the disadvantages of probate. And did Bill's last will and testament protect him from it? No, not at all. But we're not done yet, because in addition to probate, the family is going to have to endure the estate tax system. And what we're talking about are death taxes. Now, I know you've all heard about taxes. There's income taxes and gasoline taxes and property taxes and excise taxes, but we're talking about a tax that happens when you die, and it's called a death tax. Now, taxes in the United States are based upon a citizen's right to engage in certain activities. For example, the income tax. The income tax is based upon your right to engage in an activity called earning a living, and the taxes that you pay are based upon the size of the living that you earn. But there's also a tax that happens when you die, and that tax is based upon your right to give property to other people on the date of your death. And when the federal government tax you, that's called the federal estate tax. Now, there's another kind of tax as well that happens on death. It's called the inheritance tax, and many of you have heard about that. Many states have repealed the inheritance tax, but the inheritance tax is based upon a beneficiary's right to receive the property that was just taxed by the federal government. Let's ignore for a moment the inheritance tax and talk about the federal estate tax, because the federal estate tax is a very big tax. Let's talk about the history of the federal estate tax exemption. In 1981, the federal estate tax exemption was $175,625. And then in 1981, Congress realized that inflation was pushing up everybody's estate size, and they decided to pass a law called the Economic Recovery and Tax Act. And what they did was they raised the exemption to look after inflation. Well, Congress went crazy in 1981 because they raised the exemption from $175,000 to ultimately $600,000. But they didn't do it all at once. They stepped it up a little bit over a number of years, and it finally hit the $600,000 level on January the 1st, 1987. So anybody that dies after January the 1st, 1987 and has an estate of less than $600,000, there will be no estate taxes to pay, because that's less than the amount of the exemptions. But wait a minute, don't think just because your estate may be under $600,000 that you don't need to be concerned about estate planning, because remember, estate taxes are just one of the evils of estate planning. We've also got the probate and the conservatorship to worry about. But you know, they did something else in 1981 that a lot of you will be happy to know about. If you were a married person and you died and you passed all of the property to your surviving spouse, Congress said in 1981 that we're going to give a complete unlimited marital deduction. Now that means that there will be no taxes paid by the surviving spouse after the first spouse dies. Now let's talk about that. Let's just say Howard Hughes had been married on the date of his death. And let's say that lucky Mrs. Hughes had received all $2 billion from Howard's estate. Well, how much would she have had to pay in estate taxes? Well, the answer is nothing, because we've got an unlimited marital deduction. When the first spouse dies and gives it to the surviving spouse, there is no tax to pay. But wait a minute. Before we all start applauding the federal government for their generosity, let me just remind you, all they're really waiting around for is what? That's right, the second spouse to die, because then there is no marital deduction. Then the only thing we've got is the $600,000 exemption. I hope you understand that, because there are a lot of widows and widowers out there who are spreading bad rumors in the community. Oh, they'll say, hey, when my Harry died and he left all the property to me, we didn't pay anything in estate taxes. Well, they don't realize that in the United States of America, if you're married, you get the first death for free. It's the second death they get you on. And that's what we're here to talk about, the tax on the second death. And that's what estate taxation is all about, preventing that second spouse's taxation. But you know, we're not done yet, because in addition to the taxes and the probate, we've got one final evil we need to talk about, and that's something called a conservatorship. And a conservatorship is something that happens before you die. That's if you become disabled. You know, unable to manage your property because of an illness, a disability, or an injury. And you know, we're all getting older. Not just individually getting older, but society is getting older. In fact, they say that one of the largest groups in the American population are those that are over 65. Well, you all knew that. But I'll bet you didn't know that one of the fastest growing groups in the American population are those that are over 80. 25. And I read recently in the newspaper that they did a survey in the United States and found that there were more than 25,000 Americans that were over, you guessed it, 100 years old. Also one of the fastest growing groups in the American population. Now, there are a lot of diseases out there and injuries that happen to the elderly. People don't just drop over dead anymore. They sometimes go to the hospital and then they linger for many years, sometimes in not real good health. And you know, there's an injury and an illness out there that is striking the elderly population severely. It's decimating the elderly population, and when you look at the statistics, they're very gruesome. And the disease strikes the nervous system, the central nervous system, and renders a person unable to manage their property or their finances. And the disease I'm talking about, of course, you all know, is Alzheimer's disease. And Alzheimer's disease is crippling the elderly population. And let's say that Bill had Alzheimer's disease before he died. Let's say that he was in the advanced stages of it, so he was unable to manage himself or his property. And Mary wanted to sell some stocks or bonds or mutual funds, or she wanted to sell a piece of real estate, or even withdraw money from the bank. Could she do so? No, she can't. She can't because she needs Bill's signature, and Bill is legally incompetent. He's unable to sign his name, or no one will accept his signature on any kind of a contract. So what's she going to do? Well, her friends say, Mary, why don't you go down to the probate court of the Superior Court, or whatever the court's called in your jurisdiction, and say to that judge, Your Honor, I want to be named as the person to manage Bill's half of the estate. And the judge would probably say, okay, Mary, we'll name you as the conservator of Bill's estate. Sometimes in some states it's called the guardian of the estate. Whatever it is, the judge would probably say, Mary, fine, we'll name you as the conservator or the guardian of Bill's half of the estate. But Mary, I want you to realize that you're now a fiduciary in the eyes of the law. That means you must act with the highest degree of good faith and fair dealing. And we want to make sure, Mary, that you don't steal any of Bill's property. We want to make sure you don't give it away or use it inappropriately. And Mary said, but Your Honor, this is my husband. Why would I do something like that? And the judge would say to Mary, Mary, we know that you would never do that. But the law is written for everybody. And just because you're a spouse doesn't mean that the law is different for you. And so what we would suggest you do, Mary, is to divide up the assets, half in Bill's account and half in your account. And when you receive any money in, like for dividend checks or pension checks or Social Security checks, you put half in Bill's account and half in your account. When you go to the grocery store and you buy $10 worth of groceries, pay for 5 of it out of Bill's account and 5 of it out of your account. And Mary, we want you to keep scrupulously accurate records of everything you do with Bill's half of the property. And most state courts require that the conservator, Mary, would have to file reports with the court on an annual basis. And these are sometimes called inventories and accountings. And Mary would have to account for every cent she received on Bill's behalf and every cent that she spent. Now, Mary probably doesn't know how to do that. So guess who she has to hire? She has to hire attorneys. She has to hire accountants to provide these reports to the court. And this would cost a lot of money. And a conservatorship is something that you should all be very concerned about, because the incidence of conservatorship is rising in the United States. As a matter of fact, in California, if you go down to the probate court, about 2/3 of the matters on the probate calendar any day of the week are for conservatorships. Only 1/3 are for death matters. Now, I want to ask you, did Bill's last will and testament protect him from a conservatorship? No, it didn't protect him at all. Did it protect him from a probate? No, it didn't protect him from a probate. He didn't make out too badly on the taxes because he had the unlimited marital deduction. But you know, now Mary's alone, isn't she? Bill's dead, and Mary's got the whole estate. Mary's got an estate of $300,000 that belonged to Bill, and she's got her own $300,000 that belonged to her, for a total estate of $600,000. Now, Mary is something we call in the law, we call her a surviving spouse. Now, why do we call her a surviving spouse? Well, we call her a surviving spouse because she survives the death of the first spouse. Now, most of us men think that as soon as we die, that the wife's going to die a few weeks later of a broken heart. Well, it doesn't work that way. They do quite nicely without us. When the first spouse dies, generally the surviving spouse lives for about 10 years longer than the first spouse. And you know, during those 10 years, estates are going to grow. They always have, and they probably always will. So Mary's got an estate of $600,000 now, and it's probably going to grow over those 10 years. Well, what kind of a rate of inflation are we going to pick? Well, I think that we should pick a rate of inflation that, let's say, is 7%. Now, why do I pick 7%? Well, I'm not a politician. I'm not an economist. The reason I pick 7% is because I think most of us would be happy if inflation stayed at 7%. But also 7% is mathematically real simple as well, because if an estate grows for 10 years at a 7% growth rate, what's going to happen to the estate? Well, most of you accountants out there will know that the estate will double in size. So Mary, when she dies 10 years after the date of death of Bill, her estate is not going to be $600,000. It's going to be $1.2 million. Now, I know a lot of you are saying, who does this guy think he's talking to? My estate is not going to be $1.2 million when I die. But let me ask you something. If you live in a lot of states in this country, you've seen real estate prices in the last 10 years just skyrocket. What makes you think that that's not going to happen again? What makes you think that your other investments are not going to grow? If I ask you if you knew a friend 20 years ago who had an estate of $250,000, and I asked you whether you thought that friend was wealthy on the date of his death, most of you would tell me, sure, 20 years ago, $250,000, well, that's a lot of money. If I asked you if somebody died on your street this year and they had an estate, a gross estate of $250,000, would you consider them wealthy? Probably not. That's a moderate-sized estate, isn't it? When the average price of a home in a lot of places in this country is more than $150,000, many of you will agree that a $250,000 estate is not really all that large. Estates are going to grow. Yours may grow faster than your neighbor's, but it's going to grow. And so when Mary dies, she's not going to have the estate of $600,000, but $1.2 million. But you know, before Mary dies, she gets old. She gets disabled. She's unable to manage the property anymore. You know, she forgets to pay the gas and electric bill and the water bill, and she forgets to balance the checkbook. Now, she's going to need some help. But, you know, Mary went through the experience with Bill, and so she decides to nominate one of her kids to be the conservator for her if that ever happens to her. And so who does she nominate? Does she nominate her son John or her daughter Susan? Well, I can tell you one thing. She didn't nominate her son John because John is a flake. John is unreliable. He's undependable. You know, he rides a motorcycle. He's got long hair. He wears an earring, and he lives on the beach. I didn't say he lived at the beach. He lives on the beach. But fortunately for Bill and Mary, they've got another child, a daughter by the name of Susan. Oh, and Susan's this marvelous child. She made her bed every morning. She got the first dollar that she ever made pinned to her bedroom wall, and Susan could always be counted on to manage the family finances. And they picked Susan to handle the family finances in the event that Mary became disabled. And Susan had to take Mother Mary down to the Superior Court in front of the probate judge and say, Your Honor, my mom's disabled and I need to be appointed as the one to manage her assets. And so Susan, just like her Mother Mary had to do for Bill years before, Susan has to take Mary through the conservatorship process, has to go through the expense of hiring an attorney and an accountant, the humiliating experiences of reporting on an annual basis everything that she spent and everything she received on Mary's behalf. And by the way, did Mary's last will and testament protect her from a conservatorship? No, it didn't. And so this document, this last will and testament they got, has not served this family very well, has it? But we're not done yet, because 10 years after the date of death of Bill, Mary dies, and she's got this estate of $1.2 million. And the first thing that you found out was that all of the assets owned by Mary on the date of death have to go through this legal proceeding. And what's it called? You're right, probate. And all the same costs and all the same delay and the public record and the psychological trauma. And if there's real estate owned outside the state where you live, there'll probably be a probate in all those other states as well. And now we told you that probate was expensive. We told you earlier it may be a percentage of the size of your estate. Well, let me give you a number that you can really key in on. If we were to use the state of California as an example and use their probate system, it would not be uncommon that the probate fees in the state of California on an estate this size would exceed $51,000. Now, are these monies that are paid to the government? Are these monies that are paid to the court? No, they're paid to attorneys to take your estate through probate, executors, appraisers, filing fees, and those things called bond premiums. But we're not done yet, because we've got one last evil to overcome, and that is 9 months after the date of death of Mary, a knock comes to Susan's door. Remember, Susan is handling the estate for Mother Mary, and who's at the door? No, it's not John. It's the IRS agent. And the IRS agent says, Susan, we're here for our taxes. And Susan says, well, we don't owe you any taxes, do we? And the IRS agent says, of course you do. Your mom had an estate of $1.2 million. And Susan says, but I thought we had an exemption. And the IRS agent says, you do have an exemption. The exemption is $600,000. But since your mother had an estate of $1.2 million, that means you've got a taxable estate of $600,000. And Susan, you owe us taxes on those $600,000. Well, Susan says, well, I'll go get my checkbook, but when do I owe these taxes by? And the IRS agent says, now. 9 months after the date of death of the decedent, the taxes are due and payable to the federal government. And Susan gets her checkbook and she starts to write out the check made payable to the Internal Revenue Service. And she says to the Internal Revenue Service agent, how much should I make the taxes out for? And the IRS agent says, make it out in the sum of $189,800. And Susan says, my goodness, that's a lot of money. And ladies and gentlemen, you may think it's a lot of money too. But remember what I said earlier, that estate taxes are taxable at the rate of 37% to 55% of every dollar over $600,000 that you try to pass to your beneficiaries. And you can see that $189,000 is not even a third of $600,000. Why is it so low? Because I made up a whole lot of deductions just to get this number down for this family. And even with those deductions, you can see that $189,800, when added to the $51,000 in probate fees, means that Bill and Mary, for the simple act of passing their property from one spouse to the surviving spouse and then on to the kids, John and Susan, it cost this family $240,800. Is that any way to plan an estate? I hope you don't think so, and yet that's what happens every day around this country, from New York to Los Angeles, from Chicago to Miami. People who have wills where they plan their estate, passing it from one spouse to the other and then on to the kids. This is the problem that happens. Probate, death taxes, and a conservatorship. And some of you may say, gee, even if I owed that much money in taxes and in fees, I don't have that kind of cash in my estate. And if you don't have that kind of cash to pay the attorneys and the government, what's your family going to have to do? Well, they're going to have to sell assets, aren't they? Have you ever been to a probate sale or an estate sale? You know, people go there to find the best items to pay the least amount of money for them. And so it costs even more than the $240,800 worth of stuff in order to get $240,800 worth of cash. Now, is there another way? Is there a way to avoid all of the problems inherent with a will? Well, I'm sure that you understand that there is a way, and that's what this tape is all about. And some of you say, gee, I wanted to find out about that other way, but all you've been doing is rambling on about a will. Well, I hope you understand. It would do me no good to tell you about alternatives unless you first understood the problem. And the problems are probate, death taxes, and a conservatorship. And the way to avoid these problems is with something called a living trust. And a trust is an ancient legal document. It's been around for a long time. As a matter of fact, it started in Old England with something called the Statute of Uses way back in the 16th century. And a trust is merely another way to hold title to property. People just transfer their assets from themselves as individuals to this thing called a trust. There's various kinds of trust. There's something called a testamentary trust and an inter vivos trust, something called a revocable trust and something called an irrevocable trust. The document we're going to be discussing is something called a revocable inter vivos trust, and it's commonly known as a living trust. And you know, a living trust is really very simple to understand. What I want you to do is imagine that we've got a big container, a big box, a big bowl, if you will. And what we're going to do is we're going to take all of the assets that you own and we're going to change the title on those assets and deposit them in that big container. And the container we'll call the trust. Now that means we're actually going to change the title on the assets. For real estate, we're going to make up a new deed. For your stocks and bonds and mutual funds, we're going to change the certificates or change the account number. Limited partnerships, furniture, furnishings, your appliances, your jewelry, your furs, even your personal effects, we're going to change the title on them and put them in this big box. And the box is called a trust. And the trust now owns the assets. Now that we've got the trust created, it's now time to talk about the people that are associated with the trust. There are three positions associated with the administration of a trust. There's the people that actually create the trust. These people are called trustors. Sometimes they're called grantors, sometimes they're called settlors. Let's call them trustors for our purposes. And the trustors are the people that actually make the bowl or the box, and they transfer their assets into the trust. Once we've established that there is a trust that's in existence and there are assets owned by the trust, we need now to identify the people that are going to manage the assets that are in the trust. These people are called trustees. That's right, you've heard that name before. Every time you've ever heard the word trustee, that just means it's a person who is charged with managing assets that are in a trust. And the trustees can do anything that they want with assets in a trust. They can buy, they can sell, they can trade, they can exchange, they can mortgage, they can encumber. They can do anything with the assets in the trust except for one thing. There's one thing they can't do. A trustee can't spend the money on themselves. The trustees are not allowed to spend the money in the trust on themselves. The only people that are allowed to spend the money in a trust for are people that are known as beneficiaries. Now, you've heard that word before, too, haven't you? A beneficiary is the person for whom the trust is set up. A beneficiary gets all the benefit from a trust. So a trustor creates the trust, transfers the assets into it. The trustees manage the property, make all of those business and financial decisions, and the beneficiaries reap all the rewards. Now, if you only had one choice, if somebody just gave you one single choice that you could either be the trustor, the trustee, or the beneficiary, I hope you would want to be the beneficiary of a trust, because that's the person that gets to spend the money. But now let's take it out of the realm of the theoretical, and let's talk about Bill and Mary. You remember Bill and Mary that had all those problems with the will? Well, let's set them up now and create a trust. Let's pull them out of the grave, give them a second chance, something that none of us are going to get, and let's plan their estate properly now. Let's create this thing called a revocable inter vivos trust. And let me show you how it works. Let's take Bill and Mary's family. And what we're going to do is divide their family life into three periods. There's the period when they're both alive. That's the period on top. That's when Bill and Mary are alive. Then after the first spouse dies, just the surviving spouse is alive. And remember, in our example, Bill died first, and so Mary's the surviving spouse. And after the surviving spouse dies, who's alive? That's right, the children, John and Susan, and maybe grandchildren, and maybe great-grandchildren. Now you've got the lifetime of the trust. Let's talk about now setting up Bill and Mary's living trust. Well, let's give Bill and Mary a last name. Let's give them a name that I can relate to. Let's call Bill and Mary the Armstrongs. Now, why do I use the name Armstrong? Well, that's my last name, but when you create your trust, it's going to be whatever your last name is, or any name that you want to call it, and it will be your family trust. And now we've got to identify the people that are associated with Bill and Mary's trust. Now, remember, the people who created the trust, what were they called? That's right, trustors. And who are the trustors of Bill and Mary's trust? That's right, Bill and Mary are the trustors. They actually created the trust. They created a document called a living trust, and they're going to transfer their assets from themselves as individuals to the Armstrong Family Trust. Actually change the title, change the stocks and the bonds and the mutual funds and the real estate. And once all of their assets are in the trust, we need to find somebody to manage these assets for them, because they're no longer owned by Bill and Mary as individuals. And remember, the people that managed assets in the trust, what do we call them? That's right, trustees. Trustees manage the property in the trust. And who are going to be the trustees of Bill and Mary's trust? Well, some of you may have said Bill and Mary, and you're absolutely right. And some of the rest of you may say, wait a minute, I thought if we had a trust, we had to have a bank or a savings and loan or a trust company be the trustees. Not true. They perform a valuable function for people who can't manage their own assets, but you don't need to have a bank be your trustees. Bill and Mary can be their own co-trustees. They can manage the property in the trust. And remember what we said before, that a trustee can do anything with the property that they want. They can buy or sell or trade or exchange or make any financial decision except for one. They can't spend the money on themselves, because remember, the people that get to spend the money in the trust, what are they called? Beneficiaries. Well, then, who are the beneficiaries of Bill and Mary's trust? Well, some of you may already know the beneficiaries are also Bill and Mary. Bill and Mary get to spend all the money in the trust. Now, some of you I know are saying, what do you mean? You've said that there are three separate functions. There's the trustor, the trustee, and the beneficiary. beneficiary, and then you tell me that Bill and Mary occupy all three of those functions? That's right. Bill and Mary transferred the assets from themselves as individuals. They transferred it to themselves as co-trustees of the Armstrong Family Trust, and they did it for the benefit of themselves as beneficiaries of that trust. And some of you might say, well, that sounds like a fraud, or that sounds like a sham. That sounds like it's one step in front of the Internal Revenue Service. It's not true. The law allows you to create a trust that way because Bill and Mary are not always going to be the trustors, the trustees, and the beneficiaries. Remember, when Bill dies, Mary's going to be the only trustee. And when Mary dies, there's just going to be the kids and the grandchildren. But in the beginning, the law allows you to create the trust where you are trustors, trustees, and beneficiaries of your trust. Now, some of you say, wait a minute, if you live in a state where there's new property taxes, if you transfer an asset to somebody else, you say, if I transfer my real estate from myself to the trust, am I going to trigger new property taxes? Well, the answer is no. There's no new property taxes for transfers into a living trust. And other people say, but what about income taxes? Are there going to be any new federal and state and local income taxes that have to be filed for the living trust? And the answer there is no, because Bill and Mary file their personal income tax returns and report all of the income and all of the loss from the trust on their personal return. The living trust reports no income tax. All of the deductions, all of the exemptions, and all of the legal responsibility is on Bill and Mary as individuals. And years ago, you used to have to get a tax ID number for your living trust, but that was done away with around 1982. And now there's not even a number associated with your trust, except for the same number that you use to file your personal income tax returns. And that number, of course, is your Social Security number. So there's no new property taxes and no new income tax filings. And some of you say, but wait a minute, what if Bill and Mary want to change the trust somewhere down the line? What if they want to change the beneficiaries or change the trustees or add new property to the trust? Can they do that? Well, the answer is yes. They can change the trust at any time because, remember, we created something called a revocable trust. And that means that Bill and Mary can alter, change, amend, or even revoke their trust at any time while both of them are alive without any consequences. They can change the trust in any way that they want. Now, some of you say, well, wait a minute. If Bill and Mary created this trust and they have no new tax liability, either property or income tax liability, and they can change the trust in any way they want, well, what can they do with the assets that are in the trust? Well, the answer is anything they want. There is nothing that Bill and Mary cannot do with the property in the trust. When they're the trustors, the trustees, and the beneficiaries, they can do anything. They can add new property to the trust. They can manage the property, buying and selling and trading and exchanging. They can spend all of the money in the trust because they're the beneficiaries of the trust. And since they have the power to revoke the trust, they can end it at any time without any consequences. And you might say, well, it sounds like Bill and Mary are in exactly the same position after they created the trust as they were before they created it. Well, then the question is, well, then why did we create this trust anyway? Well, the answer is, if Bill becomes disabled, if Bill can't manage his property because of a disability like Alzheimer's disease or Huntington's disease or a major stroke or illness, are we going to need to have a conservatorship like we did when Bill and Mary planned with a will? Well, the answer is no. There's no conservatorship because the trust itself says that either Bill or Mary, with one signature alone, can do business on behalf of the trust. So if Bill becomes disabled, Mary, with one signature alone, can sign on behalf of the trust. No conservatorship. We have just jerked the jurisdictional rug right out from under the probate court. There's no hearings, there's no attorney's fees, no accountancy fees, and the control of the assets is kept in the family. And if Mary becomes disabled, Bill can do it with one signature alone. Well, what if Bill and Mary are both disabled at the same time? Well, you remember who we've named? We've named Susan. That's right, John is still a flake. So Susan would be able to manage the property, and she could avoid the conservatorship proceedings. So we've avoided a conservatorship. Now, remember what happened when Bill died, when he had a will? All of the assets owned by him on the date of death, well, they had to go through that legal proceeding called probate. Well, is there going to be any probate proceedings with this living trust? Well, the answer is no. There's no probate at all. That means there's no court hearings, and with no court hearings, there's no attorney's fees. There are no executor's fees. There are no filing fees in the court. There are no appraisal fees. And remember those bond premiums? Well, we do away with those as well. There's no time delay. That means that if Bill dies at 2 o'clock on a Friday afternoon, at 2:01, Mary, with one signature alone, carries on the operation of the trust. There's no public record. Nobody knows the details of Bill and Mary's family finances. You remember when I was telling you about the movie stars, about John Wayne and Marilyn Monroe, and I told you that the public knew all about their finances? Well, one of those movie stars I didn't mention was the old crooner himself. You remember Bing Crosby? Well, when Bing Crosby's first wife died, Dixie Lee, Bing Crosby found out that all of the newspaper reporters knew everything about his family finances. They knew what the size of his estate was. They knew all of the beneficiaries, and he swore that that would never happen to him again. And so he went to see his attorney, and he asked his attorney to create something called a living trust for him. And on the date of death of Bing Crosby, all of the reporters went down to the courthouse expecting to find what they always find, all the details of the family finances. And guess what they found? They found nothing. There were no reports and no estimates at all of Bing Crosby's estate, and to this day, nobody knows the size of his estate or what his family finances were. And that protects against public record with the use of a living trust. And also, there's no psychological trauma associated with a living trust. The family doesn't have to go through the long probate procedures down to the courthouse and down to the attorney's office. And finally, if there's real estate owned by Mary or Bill on the date of their deaths, there's no probate in any of the other states in the Union, because all of the assets that are transferred to the trust, even assets outside the state where you live, will avoid probate entirely. So we've avoided a conservatorship and we've avoided probate. Now we go to the evil called death taxes. Is there going to be any avoidance of death taxes when the first spouse dies? Well, yes, there is. You remember? When all of the property gets passed to a surviving spouse, we've got that thing called the unlimited marital deduction. And with the unlimited marital deduction, Bill can pass all of his estate to Mary, and there are no estate taxes. So we've avoided a conservatorship, probate, and estate taxes. But we're not done yet, because now Mary's the survivor, right? Bill's dead, and Mary's alone. Let's now examine how we would handle Mary's estate if the estate were less than $600,000. And then let's examine how we would handle it if her estate were greater than $600,000. With an estate of less than $600,000, the trust would just continue exactly as it always had. All of the assets would be owned by the trust. And who would be the trustee at this point? That's right, Mary would. Mary would be able to manage the property and do whatever she wanted. She could buy or sell or trade or exchange. In fact, the trust would be revocable or revocable. That means that she could amend it or change it or even revoke the trust if she wanted to. And who would be the beneficiary at this point? That's right, Mary's still the beneficiary. She gets to spend all of the money in the trust. But what if Mary becomes disabled? Are we going to need a conservatorship? No, we're not. Remember, we've named Susan. John's still a flake. Susan would come up and manage the property in the trust, and she would be able to handle all of the assets in the trust with just one signature alone. We've just eliminated all of the conservatorship problems. Now, when Mary dies 10 years after Bill died, you remember all the assets owned by her on the date of death when she didn't have a trust? Well, it had to go through that legal proceeding. What was it called? Probate. Is there going to be any probate with this living trust? No, there will be no probate even on Mary's death. So the property passes free of probate. And since the estate is less than $600,000, how much will the family have to pay in estate taxes? Nothing. That's right, because the estate was less than $600,000, and we've got a $600,000 federal estate tax exemption. And then the property will be distributed, half to John and half to Susan. Now, that's how it works when we've got an estate that's under the amount of the federal estate tax exemption, when it's less than $600,000. Now let's go back and talk about how we handle an estate for a married couple when the assets are going to be greater than $600,000. Well, the main trust gets divided up now into two other little sub-trusts. There's a Trust A and a Trust B. Now, the Trust A is for the surviving spouse. The Trust B is for the decedent spouse. Now, in our example, the surviving spouse was Mary, that's right, and the Trust B was for the decedent spouse, and that is Bill. Now, the B trust becomes irrevocable or irrevocable. The A trust is for the survivor, and the B trust is for the decedent. Now, why do I keep saying the A trust is for the survivor and the B trust is for the decedent? because these are what we call in the law terms of art, and you can't mix them up. You can't go and tell your friends that what happens after the first spouse dies is it gets divided up into two other little sub-trusts, and the A trust is for the decedent and the B trust is for the survivor. You can't do that because people will laugh at you. Well, I don't want anybody to laugh at you after watching this tape. I want you to understand that the A trust is for the survivor and the B trust is for the decedent. Well, how are you going to keep that straight? Well, I've got a little message and a little way for you to keep that straight. All you have to remember is that the A trust is for the one that is above ground, and the B trust is for the one that's below ground. A is alive and B is buried, whatever way you want to look at it. Now, you'll never forget that, will you? Now, we had $600,000 in the main trust, and we have to assign some of the assets to the A trust and some of the assets to the B trust. Well, how do we do that? Well, there's a formula right in the trust itself that tells you which assets will go in the A trust and which ones in the B trust. Now, we don't have to actually put the couch in the A trust and the real estate in the B trust. It's just an assignment of values into each of these little sub-trusts. Now, remember, the family had a total estate of $600,000 when Bill died. Now, half of it was owned by Mary, or $300,000, and half of it was owned by Bill, or $300,000. What we need to do is put all of the assets owned by Mary on the date of Bill's death into the A trust because she's the surviving spouse. So we put $300,000 in the A trust. The B trust contains all of the assets owned by Bill on the date of his death, and of course that's $300,000 as well. Now, the A trust is for the survivor and the B trust is for the decedent. But you know, whenever I talk about the AB trust or Bill and Mary, I get all choked up because they were friends of mine, and I know that by now you're starting to care about this family, and you're going to be shocked to find out what Mary was doing before Bill died. Well, Mary was fooling around on Bill. She was going out with this young, swarthy, handsome young lover. He wore tight leather pants and he drove a red Ferrari. You know, it was disgusting. Even at the funeral services, they're putting the last few clods of dirt on poor Bill's coffin. And here's Mary looking to the other side of the cemetery at her red Ferrari lover. And after the services were over, she tripped on across all of the headstones. She jumped into that red Ferrari, and the first thing that her new lover said to her was, "Mary! Oh, I'm so sad to hear about the loss of your husband, but you know, I have some financial problems, and I need a loan. I need some help from you, and I understand that you're flush with cash right now. So could you make me a small loan? Could you maybe write me out a check for all of the assets that are in the A trust?" Well, do you think she can do it? Sure she can. Mary's not dead, and the A trust assets belong to her. She can spend it all, she can save it all, she can reinvest it, or she can give it away. Well, if she's so stupid that she's going to write out a check to this new lover of hers, well, so be it. And so she writes out this passionate check, and he puts it in his tight back pocket. And then he's got the nerve to say, "Mary, could you kind of leave the car right now because I need to go to the bank." And so he drives off to the bank and he deposits that check in the night deposit slot of the nearest bank, and he waits for the check to clear. Now, this guy's no fool, because he comes back a few days later after the check is cleared and he said, "Mary, thank you so much for writing me a check for all the assets in the A trust, and you really helped me out with my financial problems, but I still have a few more problems. I need one more little loan. Could you please write me out one final last check, make me one last loan? Would you please give me all of the assets that are in the B trust?" Well, can Mary do it? No, she can't, because all of the assets in the B trust belong to Bill, and the B trust is irrevocable. It can't be altered, it can't be changed, it cannot be amended, and it cannot be given away, because Bill died secure in the knowledge that all of the assets in the B trust were ultimately going to go to whom? That's right, to the kids, to John and to Susan. And he wanted to make sure that Mary didn't give all those assets away. He wanted to make sure that she didn't squander them or spend them foolishly. But you know what? Bill wanted Mary to have the use of those assets in the B trust as long as they were for her legitimate living expenses, her legitimate needs. Then the question before us, ladies and gentlemen, is can we, on the one hand, create a trust that will respect the integrity of the B trust assets, and at the same time allow Mary to get into those B trust assets to spend the money for her legitimate needs? Yes, we can. That's what an AB trust is all about, and this is how it works. It's enshrined right in the Internal Revenue Code. There are sections in the code that describe the procedures to create a trust and administer it after the the first spouse dies. Now, the A trust contains all of the assets owned by Mary on the date of Bill's death, and she gets to spend all the money in the A trust. But she also gets to spend all of the income from the B trust. Now, you know the difference between income and principal, don't you? You know, income are the rents on real estate, the dividends on your stocks, the interest on your bonds, the interest on your bank account, and she gets to spend all of that, no questions asked. But the Internal Revenue Code also says that Mary can get into the B trust principal as well, up to all of it if she wants, as long as it's for one of her legitimate needs. And the Internal Revenue Code is defined those legitimate needs of Mary as her health, maintenance, support, and educational needs. And since these medical bills are Mary's health needs, she's entitled to get into the B trust principal up to all of it to pay for these medical bills. Now, some of you say, well, who does Mary have to ask in order to get permission to get into the B trust? Well, she doesn't have to ask anybody, because remember, Mary is the sole trustee. She has the right to manage all of the assets in the trust. And some of you who are real cynical out there say, well, what's to prevent Mary from getting into the B trust principal and stripping it of all of its assets and saying it's for her legitimate health needs when really she's going to give it to her boyfriend? Well, we've got a couple of people that would be watching in a situation like that. A boy by the name of John and a daughter by the name of Susan. And if Mary takes the money out of the B trust principal for illegitimate purposes, the children will be entitled to force Mary to put those principal assets back into the B trust. In addition to giving the rights to the income, the principal for the needs of health, maintenance, support, and education, the Internal Revenue Code also says that the surviving spouse has one more right to the B trust principal, and that is she can get into 5% or $5,000 of the B trust principal each and every year, whichever amount is greater. And for that right, she doesn't need a reason. So if we step back for a moment and say that Bill's now dead, and the trust is being divided up into the A trust and the B trust, and Mary's the sole trustee, and remember, the sole beneficiary, what can Mary do with the assets in the trust? Well, she's the trustee, so that means that she can manage the assets. But also she wears another hat, doesn't she? In addition to the hat as the trustee, Mary wears the hat as a beneficiary. You remember, the beneficiary, that's the one that gets to spend all of the money in the trust. She's the trustee and the beneficiary. Now, it's important you understand the difference between these two functions. The trustee is the one that gets to manage all of the property in the trust, all of the assets in the A trust and all of the assets in the B trust. Now, that means make all of the business and financial decisions, buying and selling and trading and exchanging, mortgaging and encumbering, anything that has to do with managing the assets. You remember now, Mary lives for about 10 years longer than Bill, so the assets in the A and the B trust are going to grow. Remember we talked about a 7% inflation rate? Well, if it grew at 7% for 10 years, the estate's going to double to $1.2 million. Let's put $600,000 in the A trust and $600,000 in the B trust. And Mary has complete control as the trustee of all the assets in the A and the B trust. But she's also the beneficiary. And she's the beneficiary of both trusts as well. She's the beneficiary of the A trust as to how much of it? All of it, that's right, all $600,000, and that's why I use the example of the lover, and that means that she could give all of the property away. So Mary gets to spend all the money in the A trust, but she also gets to spend some of the money in the B trust. Remember, she gets to spend the income, she gets to spend the principal for her needs of health, maintenance, support, and education, and she also gets to spend up to 5% or $5,000 of the B trust principal each and every year, whichever is greater. Now, do you understand the difference between the person that acts as the trustee and the person that acts as the beneficiary? Because if you do, you understand more estate planning than most attorneys do. Let me give you a test. Mary's old. She's disabled. She can't manage the property anymore. She can't remember to pay the gas and electric bill and the water bill. She can't remember to fill out the check register. Are we going to need a conservatorship with the trust? No, we're not, are we? We've already named Susan to take over, to manage the estate in case Mary's disabled. Well, Mary's not dead. She's just disabled. So therefore, which role is Susan going to perform? Is she going to be the trustee or the beneficiary of the trust? That's right. She's going to be the trustee. She takes over control of the checkbook. She writes the checks and pays the bills and manages the estate. And Mary remains as the beneficiary who gets all of the benefit of Susan's actions. And some of you say, well, is Susan entitled to a fee to act as the trustee? Sure she is. She's entitled to reasonable compensation. And some people always say to me, they say, do the children ever waive the fee to act as a successor trustee? Almost never. They want every dime they can get, but the kids are entitled to a fee because they're acting in a position to help the family. So we've just avoided a conservatorship. Now remember, 10 years after Bill dies, Mary's going to die, and all of the assets owned by Mary on the date of death, her $1.2 million, how much of that is going to go through probate? Absolutely none of it. Remember, we've avoided probate. There are no fees, no costs. There's no time delay. There's no public record. There's no psychological trauma, and there's no probate in any other state where they might own real estate. So we've just avoided a probate, and you know what we've done in addition? We've just saved this family $51,000 in fees and costs. But we're not done yet, because 9 months after the date of death of Mary, a knock comes to Susan's door. Remember, Susan's handling the estate as the successor trustee, and who's at the door? It's not John. No, it's the IRS agent. And the IRS agent says, Susan, we're here for our taxes. And Susan says, Mr. IRS agent, we don't owe you a dime in taxes. Well, the IRS agent kind of steps back a little bit and says, what do you mean, Susan, you don't owe us any money in taxes? Your mother just passed to you $1.2 million in your estate. And you've got all this property, and I know you've got an exemption. The exemption is $600,000, but that means you must owe us tax on the remaining $600,000. And Susan says, Mr. IRS agent, read my lips. We don't owe you any money in taxes. And the IRS agent kind of steps back and says, Susan, well, I'm a little new on the job. Could you explain to me exactly how your family cannot owe any taxes after passing $1.2 million to the beneficiaries? And Susan says, well, I'll explain it to you if I must. It happened a long time ago. My parents were very wise because they purchased a tape of attorney Robert Armstrong explaining how to avoid probate, death taxes, and a conservatorship. And after watching that tape, they learned that they could create a living trust where when both spouses were alive, they transferred all their assets into the trust. And because it was a revocable trust, they could do anything they wanted to with the assets in the trust. And if one of them became disabled, like my dad did, there was no conservatorship proceeding because Mom, with one signature alone, could carry on the operation of the trust. And then when Dad died, there was no probate because all the assets that are owned by the trust avoid probate completely. There are no fees, no costs, no delay. There's no psychological trauma or probate in any of the other states where my family owned real estate. And of course, there was no estate tax when the first spouse died because they had the unlimited marital deduction. And then after Dad died, the trust divided up into two other little trusts, the A trust and the B trust. And Mom was the sole and surviving spouse, and so she was the trustee. She could manage all of the assets in the trust, all $1.2 million, because the estate grew from $600,000 to $1.2 million. And my mom was not only the trustee, but she was the beneficiary. She could spend all the money in the A trust, and she could spend the income, the principal for her needs of health, maintenance, support, and education from the B trust, and also 5% or $5,000 of the B trust principal, whichever was greater, each and every year. And then Mom became disabled, and we avoided a conservatorship again because I was named as the person to manage the estate in case Mom became disabled. And so we avoided a conservatorship, and then Mom died. God rest her soul. And on the date of her death, there was no probate at all because we avoided all the probate because all of the assets owned in both the A and the B trust avoid probate on the date of Mom's death. And Mr. IRS agent, for tax purposes, the only assets that my mom was considered to have owned on the date of her death were only the assets in the A trust, and only to the extent that they exceeded the amount of the exemption available on the date of her death. Now, what's the exemption? $600,000. That's right. How much is in the A trust? $600,000. So how much does this family have to pay in estate taxes? Absolutely nothing. And some of you say, well, wait a minute. What about the property in the B trust? What about that other $600,000? Why is Mary's estate not considered to own the assets in the B trust? Well, it's not considered to own the assets in the B trust because the B trust, from the date that Bill died, has become irrevocable or irrevocable. It can't be altered, it can't be changed, and it cannot be amended. And because of those terms of the B trust, it's never been considered to be owned for tax purposes by Mary. Oh, she's got the right to manage the property, and she's got the right to spend the income, the principal for her needs of health, maintenance, support, and education, and the 5 and 5 power. But for tax purposes, she's not considered to own the assets in the B trust. And so regardless of how big the B trust gets, if it grew from 300 to 600 or to 800,000, it would make no difference. We never consider the assets in the B trust for estate tax purposes on the date of the second spouse's death. The only thing we look to are the assets that are in the A trust, whether they're greater or less than 600,000. So if the A trust had grown instead of to 600,000, let's say it had grown to 800,000. Now would the family owe taxes? You bet they would. They'd owe taxes on the $200,000 in excess of the $600,000 in the A trust. And ladies and gentlemen, if you understand this, you understand how a living trust, as of January the 1st, 1987, can pass $1.2 million absolutely tax-free to your heirs. And after the second spouse dies, the A and the B trust come together again. They merge together again, because after all, we generally divided it just to avoid the estate taxes. And after the second spouse dies, they come together again. And the person that looks after the estate after Mary's dead, who's that? That's right, it's Susan. Susan's the successor trustee. And she says, well, what am I supposed to do after Mom dies? And she looks in the trust and it says, upon the death of the surviving spouse, that's Mary, the successor trustee, that's Susan, takes control of the existing trust estate, $1.2 million. And she's supposed to divide it up into 2 separate and equal shares so as to provide 1/2 for Susan and 1/2 for her flaky brother John. And then she's supposed to distribute the property free of the trust so that Susan puts $600,000 in her pocket and John puts $600,000 in his pocket. And ladies and gentlemen, the trust is over. It's done with. All the property has been distributed. And what we've done is we've avoided a probate, we've avoided death taxes up to $1.2 million, and we've avoided a conservatorship, both when the first spouse was alive and when the second spouse was alive. But the very best thing of all about a living